everyone. Welcome. You're watching This is BTTV. I'm Sakshi, Batra, and this is Market Today, a show where we'll help you understand the closing action on the D Street. Let's start off with the Nifty and the Sensex and see how they are trading at right now as we begin the last half an hour of trade. The markets have given up. They're off the day's high point for sure, but 17,600 still remains on the Nifty 50. It's up by about 44 odd points. The Sensex hovering about 150 points higher at 59,845 as well. Another quarter percent of an uptick that you can actually see on both these benchmarks. When we talk about the broader markets, the mid and the small cap 100 indices, remember they were trading at 0.6, 0.7% earlier in the day, and they're holding up onto those gains, especially the small cap 100 index still hovering near the day's high point at this point in time at 9196. Now, when we talk about the mid cap 100 index, also in tandem, 0.6% of an upside can be seen. Now, when we talk about the other sectors of the Nifty, the move that you're seeing right here, you will see that the Nifty Realty index is continuing to climb up. It's leading the sectoral indices with a 2.75% of a move on the upside. Apart from this, we did see moves coming in on the Nifty Bank as well. There is a slight profit taking that you've seen on that index. 41,000, however, still remains on the Nifty Bank currently. Apart from the FMCG and IT, rest of the sectors still holding up onto some of the gains right there, with the autos moving higher by 1%, financial services up by 1%, half odd percent gains coming in for the metals and the pharma counters as well. So largely in the green is what you can actually see today's trading session, and of course this comes on the back of the RBI's pause on the rate hike cycle. We have seen finally the pause coming in. RBI decided to keep the repo rate unchanged at 6.5%, and the MPC unanimously decided to keep the repo rate unchanged in this meeting, with readiness to act should the situation warrant. Now, markets definitely gave initially a big thumbs up. There has been some profit taking, but let's try and understand what this really means for you as an investor of equities, of fixed instruments, and also of commodities like gold. Joining in now to help us with the insights on markets and more is Mr. Nipun Mehta, well-known market expert. Mr. Mehta, good afternoon, and thank you so much for taking the time out for this discussion. I want to begin by understanding your take on the RBI's move to decouple from the global tightening cycle and pausing the interest rate hike.
Good afternoon, Sakshi. I think it's a very interesting move by RBI in pausing interest rates at a time when probably the inflation figures that have come in the last couple of months haven't been really too comfortable. They have been fairly close to or marginally higher than what RBI predicted. At the same time, a couple of important points as far as global interest rates are concerned. You're still seeing large country economies, or depending on which country we're talking about, either a 25 or 50 basis point rate hike that is there still in an effort to control inflation, while this pause clearly indicates that RBI believes it has inflation reasonably under control and probably wants to start now focusing more on growth, ensuring that rate hikes don't create an impact as far as growth is concerned, economic growth is concerned. So very positive development as far as interest rates or the bond markets are concerned, and should in a way boost the economy if inflation doesn't really rise over the next couple of months. We could probably have seen then the end of the rate hike cycle.
Yeah, exactly. That's what I was coming to, that if you believe whether the interest rate cycle has now reached its peak, is it the end of the rate hike cycle? Are we in for a prolonged pause, or therefore are you looking at also positively a rate cut or a reversal coming in soon as well?
So I think one needs to have several factors on which could act as pointers, and exactly as the governor has also said, inflation needs to come under control on the one side. On the other side, the fact that the OPEC countries have announced a production cut for crude oil, it could just ensure that the crude oil prices stay fairly elevated. And the RBI projection on crude oil price as an average throughout the year is $85. That's where we are at currently. Probably that's something that's likely to create an impact of whether inflation would come under control or no. And of course, we have the food prices that are critical. Monsoon will play an important role, whether food prices would remain under control or not. And that's something that could indicate whether inflation would be fairly stable or it could move downwards. Both these would be critical factors. And I think that's where RBI would define and determine how interest rates should move over the next couple of meetings that are there. If inflation does come under control, you would probably have seen the last of the rate hikes.
Right. Also, your take on the projections on both growth and on inflation, softened stance on inflation projections and uptick on the growth projections as well at 6.5%. I mean, do you know of any other projections matching this? This is coming at a time when the World Bank and other major conglomerates are actually looking at slower growth at this point in time. What is giving the confidence to the RBI that we are likely to grow at 6.5%, and how will the RBI really justify this figure?
So you're right. I think most projections that have otherwise come for India have been lower, and uh, this, of course, is 6.5 is a projection that's, of course, marginally higher than the 6.4 projected, but it also comes down from the 7% that was projected
Yeah.
last year. But I think the important point is indicators that are showing that the economy is fairly robust. The rate hike will obviously impact profitability of the corporate sector to an extent. But when you look at the tax collection, both direct and indirect, when you look at the fairly robust GST collections that one is seeing, when one sees that the current account deficit is fairly healthy, and it's come down significantly given the kind of services and manufacturing exports that we are seeing. I think those are indicators that the economy is well on well in line for a reasonable amount of growth of the type RBI projected. It could even be marginally higher if global conditions stabilize. If there is limited uncertainty on the banking sector, as we've seen, the global banking sector, as we've seen over the last couple of months. The
Yeah.
moment is that stability, you're likely to see probably even marginally higher GDP growth that might just come about for FY24.
Okay, but is this RBI's no rate hike mantra really the best case scenario for the Nifty bulls, and can it really pull the Nifty out from the long phase of consolidation that we've been looking at?
So I think broadly the street did expect a 25 basis point hike.
Yeah.
A pause is very clearly a positive. But I think the key is the kind of rate movements that one sees, or even further, the currency movements that one is likely to see. I think if the GDP growth rate, or if one sees corporate sector growing at the pace that one is expected, that the street is expecting, you could even see currency, the rupee, appreciating in comparison to the dollar. Uh, Again, if there are no further rate hikes as far as the Fed is concerned, that is again something that could
Yeah.
ensure that the dollar weakens a little, and there could be far greater flows as far as the emerging markets are concerned. Given the fact that clearly the emerging economies are faring far stronger than with China also gradually limping back.
Yeah.
Clearly, there are indications that emerging economies are coming back, and that's where flows could come by as far as emerging markets are concerned, and the currency markets could look very different 6 months from now in comparison to
Yeah.
what we have.
But do you think the equity markets have made a bottom, at least in the near term for now?
So I think a lot would depend on the kind of corporate sector earnings that come by. I mean, the
Yeah.
clear indications, at least immediately, seem to be that the March quarter should be good. A lot will depend also on the management commentary that comes by for a lot of the export-oriented companies. While one is seeing healthy exports, are they likely to see continued order flows, particularly, let's say, the services companies, some of the manufacturing companies as well? A lot could probably depend on that. Sometimes when markets are falling, sometimes it's risk management becomes key. But with the way clearly the indications coming by as far as economic or data points are concerned seem to be fairly positive as far as India are concerned.
And what would you tell equity investors to do now? How should they really approach investments at this point in time in equities? I mean, for now, they had been looking at a scenario when we were constantly in a rising rate scenario, and they must have been mulling that at a time when the markets are extremely volatile and the outlook looks fairly uncertain at this point. They may be mulling to shift some of their equity investments to income instruments as well. Now that we have hit a pause at here and we are hoping that it will be a prolonged pause, what would you tell the equity investors to do?
So two or three things. I think one, asset allocation becomes important, and that's why allocating money to fixed income is never a problem. Should never be a problem. I think based on your asset allocation, there should be a reasonable amount to other commodities as well. So when one is looking at bullion and the way gold has performed, that's something that should also feature in the overall asset allocation. As far as equity markets are concerned, I think one needs to appreciate that the going is not necessarily throughout the year, not necessarily going to be very smooth. It could be, it would probably be volatile. Getting double-digit returns should be considered as really positive, which would mean that if there are dips in the market and if, given the global uncertainty on various parameters, various factors, as in geopolitical uncertainty and or the banking crisis that got created maybe in the last couple of months. Given that fact, a degree of volatility can be expected, and any sharp dip in the market is should be taken as an opportunity to take greater positions as far as equities are concerned. So I think that volatility should be taken benefit of whenever there's a fall as far as markets are concerned by investors constantly nibbling into some of the blue chips that are there.
Okay, and just for the FD investors, they may have certain queries now. I mean, like, have the FD interest rates really reached closer to the peak of the current cycle, or will it take some more time? What could be the best time to really go in for long-term FDs right now? I mean, like, and what could be the best course for FD investments per se? Now, banks, we think, are yet to transmit the full repo rate hikes to FD rates as of now. What would you advise the investors of FDs?
So I think one can allocate long-term money to FDs for sure. For those, a lot would depend on whether you would like to allocate money to FDs or to corporate bonds or to government treasury, the government bonds, or to debt mutual funds. So depending on the tax liability of each individual, depending on the risk-taking ability of each individual, you could have allocation to any of these. And if one does do, now that the taxation for virtually all these debt instruments is the same, one could look at, depending on the risk-taking ability, one could look at different instruments. But one can for sure take long-term exposure now to debt for reasonably sustained returns.
And you briefly mentioned about gold also, sir. We've been seeing that gold has been inching at lifetime high prices, at least domestically. Your own thoughts here, and how should investors be really looking at gold, looking at the kind of love that Indians have for gold? Any opportunity they don't, want to miss to grab more gold in their portfolios. Now with the rate hike cycle getting paused, how will gold investments get impacted?
So I think an allocation to gold, like I said earlier, always made sense depending on how you really end up taking exposure to gold. But yes, anywhere from 5 to 8 or going up to 10% allocation to gold, a lot of times does make sense on a longer term basis. And one has really seen over the last, say, 2 or 3 years, reasonable appreciation as far as gold is concerned. So in terms of that allocation, one does need to take exposure to gold. Of course, whenever there is risk of trade, one does see investors flocking on to gold, and that's how you're really seeing fairly stable global prices or rising gold prices globally. Our sense is uh, if the interest rates cycle has turned and you are likely to see gradual rate cuts, there might not be too much of upward appreciation upward movement as far as gold is concerned. Nevertheless, like I said, on the basis of asset allocation, one should have exposure to gold in any case.
Okay. In the end, I actually wanted to digress a bit and also take a bite from you in case you've been perhaps reading through some of these guidelines that have been coming from SEBI on the regulations for fin influencers, including investment advisors and research analysts. What's your take on the kind of, SEBI guidelines that have come through? And how is it likely to impact the market participants, such as the fin influencers and investment advisors?
Well, I think any incremental safeguarding of investor interest by the regulator is always welcome. Some of these guidelines sometimes do feel fairly strict, but I think clearly the way some of them sometimes get misused, I think it's clearly in the interest of the common investor that these guidelines are implemented, imposed and implemented by SEBI in order to ensure that at least the lay investor doesn't miss out or doesn't get misguided by some of the influences that might be there around.
Right. Okay. Thank you very much, Mr. Mehta, for being with us on the show and discussing with us all these insights post the RBI's policy and what it means for investors at large, be it of equities, FDs, gold, and going forward from here, what do we expect going forward as the trajectory of the markets going forward as well. Many thanks for being with us. Always a pleasure having you with us on Business Today TV. Well, the markets are inching higher slightly again. You can see a 140-point uptick for the Sensex, 59,828. So it's slightly volatile and still holding up at 0.2% higher for the benchmark indices. However, look at the Nifty as well, slightly slipped below that 17,600 mark. 15 minutes to go, and we'll have to just wait and watch to find out whether that level really remains put towards the closing of the session as well. We'll keep an eye out on the market movement, and you can also track all of that if you stay with us on Business Today TV. Don't forget to subscribe to this channel, and also you can continue to engage with us on our other social media platforms, that's Facebook, Twitter, LinkedIn, and Instagram. Until then, many thanks for tuning in.
Hello and welcome to Business Today's